then when you get into the low side, if you have a lot of liquidity, that's where you really make up the difference. And I try to tell this to people. I said, don't worry about every single year so much, but know where you can really pick up a lot of territory. And that's off the low. If you can pick up 50, 60% off the low in that first year or 15, 18 months, that goes a long way to making a portfolio look great over the next 5 years. And that's all we've tried to mention to people. And also the flip side is true. If you can keep from losing a lot of money at the high, even though you don't have liquidity, that also helps you out too. Those two extremes really help you out, so that when you get into these periods where it's steady market for 4 or 5 years, you may not do as well or, as you might want to, but you're doing okay. But where you make it up is those extremes. And I think that's what people have to realize. How do you know how to work the extremes?
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with financial advisor Ted Oakley. If you haven't yet watched part 1 of this discussion with Ted, in which he explains why, once the ongoing bear market puts in a bottom later this year, he sees tremendous opportunity ahead for those investors prudent enough to have preserved dry powder to deploy, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. Ted has also generously shared how he's currently allocating client capital for the turbulent year he sees ahead, so be sure to stick around to hear that. But okay, well, let's get started watching part 2 of our interview with Ted Oakley. Broadly speaking, this is a good time to emphasize liquidity, because you see continued downside ahead. And this is where I've been trying to take the conversation this whole time, is once the capitulation event has happened, there very well may be an amazingly good time to deploy capital. And we have seen that moment of opportunity happen at the end of down cycles at previous points in history, at previous points in your investing career, Ted. And I really want to talk about that opportunity in just a second. But is what I said, did I, on a broad basis, correctly capture how you're looking at things?
Oh, totally. I think people, for the first time ever too, I've said this, use it in speeches a lot, that savings is back. I mean, you can have short-term money now and make, 4.5% on it. And that hasn't happened in a long, long time. So why get too overly aggressive right here and try to guess these things out? Let it play itself out. You're not, even if you miss 5% off the low, it's okay. You'll still be in great shape. But the opportunity there that you mentioned, there'll be some really good opportunity, I think, at some point.
All right, great. So you put up a chart in your investor update from Oxbow's CIO, from Chance, titled "Liquidity Makes a Difference," which shows basically the following 12-month returns after major market bottoms. Can you just speak to that briefly? Because I want folks to understand the size of the magnitude of the potential opportunity here for folks that take the prudent course and build up dry capital and have it available to deploy at these key moments.
Well, it's interesting, and I guess everybody has to run money the way they felt like they should do it. And for us, one of the things we've always been, our best years have always been off market lows, 03, 09. And what happens is, and some people go a different direction. You'll find there's flavors of money management. Okay. Some managers are really good in a bull market, and they just, they run off and leave everybody, and then they just give it all back in a down market. That's not like what we like to do. Okay. We, as the markets go to extreme highs, and they were extreme highs and really for 3 years almost there, we like to start to cut back on that so we can create liquidity, and we just keep creating more and more and more. Now, we run the risk, I'll just tell you internally, we run the risk of losing some business because somebody can walk in and say, well, you're not staying up with the S&P 500. Well, you know what? I don't want to. And the reason I don't, because things are really expensive. So obviously we're not, because we're raising cash. And so, but we still make good money. But then when you get into the low side, if you have a lot of liquidity, that's where you really make up the difference. And I try to tell this to people. I said, don't worry about every single year so much, but know where you can really pick up a lot of territory. And that's off the low. If you can pick up 50, 60% off the low in that first year or 15, 18 months, that goes a long way to making a portfolio look great over the next 5 years. And that's all we've tried to mention to people. And also the flip side is true. If you can keep from losing a lot of money at the high, even though you don't have liquidity, that also helps you out too. Those two extremes really help you out, so that when you get into these periods where it's steady market for 4 or 5 years, you may not do as well or as you might want to, but you're doing okay. But where you make it up is those extremes. And I think that's what people have to realize. How do you know how to work the extremes?
Great. So much of what I talk about with Wealthion's advisors who come on this channel every week is the wisdom of sidestepping the drawdowns, if you can, right? Of not being overly exposed at the time where the market gets really rich, because the risk of a big downside is higher at those moments. And you've been at this long enough, Ted, to know that if you can avoid those big downdrafts, you save yourself a lot of years of having to rebuild, right? So that's like, priority number one is don't get caught in the downdrafts. But then priority number two is exactly what we're talking about here, right? Is if you can be prudently positioned after a drawdraft with available capital to deploy and to be able to ride that sort of big market snapback, that can be a tremendous accelerator and basically, again, catapulting you years ahead of the future in terms of what your returns would be versus a normal sort of steady eddy market, where I'm just hammering these 2 points home because I think if you're fortunate enough to be able to combine them together, I don't want to overstate this, but it's the best of both worlds for an investor, right? Is you're using risk mitigation really prudently, and you're using like really prudent deployment when the odds are overwhelmingly in your favor, to then get the growth when it's safe enough to take that kind of stretch.
Well, and I do think that's true. I mean, one of the things we've always tried to do, Adam, is we've tried to run the kind of portfolio that after these really rough periods, that within 18 to 24 months, we're back at a new high in the portfolio. Now, the only way you can do that is to have liquidity. And I would say personally, I'm probably overly conservative. I grew up quite poor. And so I have a problem in going backwards and losing money because it takes too much to make it. And I find that this idea that don't worry about losing it because it'll be okay in the long run. Well, we do worry about losing it.
Right.
Because you're losing it. Okay. And so this idea that just don't worry about it, it'll be okay 20 years from now doesn't really fly too well with Oxbow, but that's our firm.
Yeah, well, no, I appreciate that. And I always say, look, financial advisors are loath to have high liquidity, positions of high liquidity, because their fear is their customer can say, well, I can be in cash myself, right? So what am I paying you for, right? And I always say, you're paying for the expertise to know when to be liquid, right? And we've just done a really good job of explaining why that has such great value, right? So I really respect your firms, and it's the same with the other firms that Wealthion endorses, where especially firms like New Harbor have been very high cash going into 2022, and they had the constitution to be able to withstand the people that were challenging that position. And of course, it served them incredibly well in 2022, right? And it sounds like the same thing for you and your firm. But I know that it's not an easy position to be in, and you have to have a lot of courage and a lot of thick skin to be able to challenge the doubters in those periods. So anyways, congratulations to you. I just want to mention it, Ted, because you briefly alluded to it. You shared your backstory in earlier appearances on this channel. But I mean, you grew up not wealthy. I mean, you grew up in a house that didn't have running water, right? I mean, you know what it's like to really be starting from the very bottom, and obviously you've learned very well in life how to create wealth, not just for yourself, but for others as well.
Well, that's true. And I don't think I'm such an anomaly. I know so many successful people that had extremely poor backgrounds. And I always love visiting with them to see, how it happened for them. There's a lot of people out there like that. I mean, and I will, I'll tell you when you're a 4 or 5-year-old and you think you might fall into an outhouse, it makes you stop and think about it, especially if it's dark. And so I've experienced all those things, but there's so many people that I know, even in this industry, that didn't do well. But I love American business out there, because I know so many business owners that started with really nothing. I mean, they just bootstrapped it, and they were really, really poor. And they give me an uplifting feeling. I love to visit with them. So there's a lot of people out there like that. I don't classify myself is really a standout, because there's a lot of great successful people like that.
There are, and that also shows your humility, Ted. But the point I want to really underscore here is just the way that I'm sure that even today, you still have a really healthy respect for indoor plumbing based upon your childhood experience.
I do, and I'll tell you, we work primarily with business owners that have sold companies over the last 35 years. And one of the things I find out about, especially the ones that didn't have anything, is interesting. No matter how much money they get, they're still running scared.
Yeah.
And I find that, and that's something that gets in and you have to get past that. But I know why they think that way.
Well, you and I, we actually went kind of deep into that psychology, I think, in the last time you were on this program. And I'll try to find a link to that video. And if I can, I'll put it up here so that folks who are interested in that part of the psychology part of investing can more deeply dive into that, because that is extremely important. And there's a lot of important, things to realize about how our psychology can really work either for or really work against us in ways that maybe we're not, conscious of normally. But where I was going with this is you, just like I'm sure you have a real appreciation for indoor plumbing, like you have a real appreciation for what it takes to earn wealth, and therefore not to be cavalier with it, right? Which is, I think, exactly what that's the mindset that people want to have in their financial advisor, is somebody that really understands the true value of wealth, how hard it is to earn, what it takes to amass it. And so they're not putting it at undue risk. So that, you get the talk the next morning of, well, in 20 years, you're going to be fine, right? I presume, given your background, you never want to have that conversation with somebody.
Well, I don't, because obviously, our losses were very contained this year. Actually, I think anybody would have taken our numbers if you want to know the truth. But still, we take everybody's money seriously, because if they're losing even small amounts of money, it's bothersome, okay? And like, we'll do everything in our power to try to manage through that and make it work. And I hate to see it, really. I don't like to see people, and I never really just say, well, this idea about Wall Street, well, you're down 30, but hey, the market was down 40. That makes no sense to us, because you're still down 30.
Right.
And so that's where we come from on it.
All right. Well, I'm sure there's a lot of people watching here saying, I want a guy like Ted Oakley managing my money. All right, Ted. So look, as we wrap up here, I want to just get to your 4 summary bullets coming out of your ending your quarterly one investor outlook. We've talked about a lot of this stuff. I'll just give you a chance to give any sort of parting context to them, if there's any you'd like to give. The first one is, liquidity is more important now than at any time in the past 4 quarters. I assume that's still true, as much true today as it was when you released the outlook a few weeks back.
It is, because what happens is, when you get in a situation where everybody then is beginning to hurt, then they do irrational things. And so when they do irrational things, you want to have liquidity, because that means you're going to buy real estate cheap, you're going to buy oil and gas cheap, private business cheap, stocks. See, it all fits together. And right now, that we haven't gotten to that point, though. That's what I'm saying. And so you have to have that liquidity right now.
All right, great. Your second point was that we're coming to the heart of the negative economic outlook. And I guess I interpret that, and correct this if it's wrong, is the real pain in terms of the economy slowing, a recession arriving, still lies ahead of us here.
It is, 22 was really about the Fed and interest rates, if you get right down to it. 23 is going to be about the economy. I mean, the other won't make any difference, because if you keep going down on the economy, then pricing on things is going to have trouble.
Okay, so basically here, I take it, it's just sort of, assume the crash position, right? Get your helmet on, get your defensive stance in place, like just be ready for the macro environment to get more painful going forward.
And I don't know what the number is. I just know, and it wouldn't surprise me to have a series of down 15, up 15, down 20, up 20, that sort of thing. That happens too. So, but I suspect that you're going to have to reprice everything going into this next 2 to 3 or 4 quarters.
Okay. Raised cash levels should be very profitable later this year, was your point number 3. I think that speaks to the, chances chart about the rebounds, off of the lows. Anything else you want to add to that?
Well, for the first time in a long time, and you could do this, after March of 22, but for the first time in many years, really, you can get 4.5% on your liquid money. We have probably, we have billions of dollars in over $1 billion, I know, in the floating rate U.S. Treasury, floating rate. Okay. It means the principal's not moving up or down. I think we're up to about 460 today, or 465 pays quarterly. I mean, you can afford to wait. I mean, did you make 4.5% last year? That's my question.
Exactly.
And so if you didn't, why worry about a 4 or 5 days in the early part of the year where the market moved up a little bit? Why don't you carry that liquidity, see where that takes you, and you've got plenty of time. Like I say, you can make a low in stocks and miss the first 5 or 6, 7, 8%, and you'll be just fine.
Okay, great point. All right, and then your last one here is be careful of an overzealous Wall Street.
Well, I say that because of this. If you look at most people on the advising side of the business that are, say, under 35, I'm going to use that as an example, or maybe under 38 or 40, you'll find very few of them are carrying really high cash levels. And that's because of the extent of what they've experienced the last 13 or 14 years. They haven't had to do that. So naturally, that's how they grew up. And Wall Street will stay zealous like that. They will. They'll keep saying, buy the stocks, don't let it throw you off. Keep on buying. And they'll buy that all the way through to the low. And then you'll see some reports that say, hey, well, you might want to cut back on this one or that one. That they're usually on the wrong side. I've watched Wall Street for decades, and they're typically on the wrong side of the trade. And I still think they're on the wrong side of this one.
And I would assume, like you said, when people start getting nervous, they start making rash choices and decisions, that Wall Street's the same way. Both in terms of how they manage money, but also in terms of how they market their products and services.
It is. I think the hardest thing in Wall Street is this, and you'll notice this with strategists, analysts, investment advisors, that sort of thing. It's very hard for them not to be in the group. If all of a sudden they're doing something that puts them out here alone and it's contra, it's almost impossible for that group to do that. They just can't do it. Now, they can keep their jobs by being, in the middle of the pack. They can do that. But is it really good for the investor? And so I think what people have to realize is that most of what goes on today in the big investment banks comes from the top. Most of the quote unquote wealth managers you see at these really big investment firms, they're not calling that shot. That's coming from somewhere else. And so, walk into one of these firms one time and just say, why'd you buy that stock? See if they can tell you. And that's what we always tell everybody. And I think that's what you have to keep in mind, especially during a tough time.
Well, Ted, these are pearls of wisdom. Thank you so much for giving us so many and so much of your time and your expertise over the course of this conversation. I know we ran a little bit long. I think the audience is going to be very pleased you were willing to do that. For folks that have really enjoyed this interview, maybe this is the first time they're getting a chance to know you. Where can they go to learn more about you and your work and what you do at Oxbow?
Well, the best place to add them is go to the website, oxbowadvisors.com. And you'll see, we've written a lot of books. We have a lot of interview, different things. You'll see you'll see everything that we do, really, our market letter. We've got a new book that'll be coming out in March too. So, we will, you'll find everything there, and that's really the best place to go.
Okay, great. And Oxbow has a Twitter account too as well, right?
We do. We have YouTube, Twitter, LinkedIn. We're in those places. I can't take credit for that. I have to give the marketing group credit for that because I don't do much of that.
Okay. I know they're good places to follow you and your work though. So I'll put up the link to your Twitter handle as well as the Oxbow website when we edit this video. All right, folks. Well, look, in wrapping up here, just want to let you folks know that we are continuing our process of me writing up my key takeaways from the big interviews that we do each week. To get mine from this interview with Ted for free, including many of the charts that we showed on the screen here, just go to wealthion.com/AdamsNotes to get your hands on that. Ted, it's been an absolute pleasure. Really hope we can have you back on this channel again soon. I wish you and all your clients a wonderful and very prosperous 2023. And again, it's just a joy to be able to interview you, Ted.
Thanks, Adam.
All right. Well, now's the time on the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Wealthion, to both react to what Ted and I talked about, but also talk about what's going on in the markets right now since they were on last week. I'm joined as usual by lead partners John Lodra and Mike Preston. Guys, great to see you. It's always wonderful to hear from Ted. He's just such a great sage of the markets and just investing and wealth building. Sort of such a calm hand on the tiller, and just lots of pearls of wisdom there. So I'm really curious to hear what you guys appreciated and took away from that conversation. Mike, why don't we start with you?
Yeah, I really enjoyed the talk, Adam. Thank you. I might jump right to the punchline here and then backfill with some other parts of his talk. Ted talked a lot about liquidity. Liquidity is really important. We've been preaching that for years. It feels like too many years. We certainly underestimated just how long the Fed has been able to put the pedal to the metal, put the foot on the gas, and keep this market going for quite a bit longer than it really should have. And we sit at valuation multiples that are well above previous peaks, 1929 and the 2000 peak. And so there's nothing but risk. And another way of saying that is we have a negative expected return, in our opinion, on the S&P over the next decade or more. And yet the market is still very near its high. We had a down market last year, but it was a very controlled decline. We were down, maybe 19% on the S&P. It was maybe 7 or 8% on the Dow. These are approximate numbers. And there really hasn't been any panic. As Ted said, investors are obsessed with catching the low. They're obsessed with catching the low, and they're front running what they think is going to be a Fed pivot. Ted points out that we really shouldn't count on a Fed pivot. Powell seems to be convinced or it seems to have decided that he wants to have the Federal Reserve not be in charge of running the markets. I'm not sure I totally believe that he believes that. I think it's going to be very difficult for the Fed and any central bank to stop believing that they can control these things and that they're their responsibility, but certainly seems to be convinced that he wants to manage inflation. And I think that any Fed pivot is likely to be a lot lower. Ted talks about S&P earnings. He talks about earnings going down and that we're in the early phases of an economic contraction. He sees earnings going down. We see the same thing. There's various charts and stuff. I know that John's probably going to share one in a little bit that shows the trend of earnings. Bottom line is that earnings are trending down, labor costs are going up, commodity costs are going up, and we sit at a very, very rich multiple. So market risk really comes about in two ways. One is contracting earnings because stock prices are just some multiple of earnings, and then multiple contraction. When risk aversion starts to kick in, you go from a multiple that's very high to something that's more normal, and oftentimes you'll go to the low side of normal. You'll overshoot to the downside. which can be very dangerous. That's how you can get a market that falls 50%. And this market could easily fall 50% from its high so far anyway, of 4,800 on the S&P. It could easily fall 50% from here, which is we're around 4,000 on the S&P. So I'll stop there for a moment and add some more comments later, but there was a lot of things that we resonated with in his talk. So thank you.
All right, great observations. And as you said, Mike, liquidity has just driven markets forever here. And sort of where liquidity is going, it's a good sign of where markets are going. There was that M2 chart that Ted put up that really caught my attention, which was, the yearly chart from 1960. Every single year in the data series, M2 had grown, except for 2022, where we are right now, right? Which, you have to be careful using the words. It's different this time, but certainly in terms of money supply expansion, for those that have been around since 1960, which is almost everybody watching this video, it is different this time from a liquidity standpoint there. All right, John, let's hand the baton to you.
Thanks, Adam. Good to be back. I too very much enjoyed Ted's talk. He's quite a nice gentleman. Comes across as very, very trustworthy, and really resonate with his humble roots. Mike and I are fortunate the lives we live and the lives we've had, but we too came from somewhat modest roots. All to say that in our jobs as investment managers for real people, real households, we kind of get it. We understand the importance of how the assets they entrust to us connect to their real lives and what it resembles in terms of their hard work and oftentimes sacrifice. So appreciate his perspectives there. Mike touched upon some of the key points. I mean, Ted had really talked about the signs of economics slowing. He thinks we're likely to see the recent trend in earnings revisions downward continue in a substantial way. Wall Street analysts have a notorious history for being late to the party in terms of ratcheting down their earnings estimates. And I'm going to share a chart here that Mike alluded to just to kind of put some color to that. Just bear with me here. So let's go here. Can y'all see that chart there?
Yep, we see it fine.
All right, so it's a data pulled together by FactSet and Goldman Sachs. Basically, it shows for a bunch of calendar years the analysts' forecasts and how those forecasts evolved over time as the year in question approached. So, for example, you see 2023 started way up here, close to around the $250 per share on the S&P measure, and so far there's been some pretty healthy reductions down to about the 230 range or so. Well, a couple notable things I'd like to call out in this chart, and they're actually highlighted in blue here. These are years that were defined by pretty steep recessions. And what you notice here is that the pace at revisions here to the downside is very similar in terms of slope as some of those deep contractions. But if there's any, if history's any guide, if today's any analog to those prior episodes, we should see these earnings forecasts go down substantially more. Ted believes in his comments in the video we just watched that we're likely to go somewhere below $200 a share. We agree. We probably think somewhere in the 180, 190, somewhere south of 200 is quite a feasible and perhaps even likely scenario. And that has key implications because we talk about multiples. Right now, the S&P is trading on a forward earnings multiple of about 17 times. We're not big fans of using single year forward earnings PE ratios, as they're not very robust in terms of the future. But nowhere near prior market bottoms. These valuations typically will end up in the low double digits, if not lower. And I'm just going to pull up another chart just to kind of make the point. This is a chart of the Shiller PE, which we can go back and look at for a long period of time. This is a more robust indicator in that it smooths out the business cycle, looks at things over 10-year period. And right now we're at about 29 on that metric. You can see in the market low in the housing bust that got down to about 15, which is around where the long-term median is. You look at the tech bubble, it got down, somewhere in the high teens. Back to the generational low of 1982, we're talking about single digits, 7 or so. So we are not seeing the kind of valuations and margin compression that typically accompanies a durable market low. So there's been headlines out there talking about this year, this changes calendar year has the markings of a new bull market. We don't see that in the data, and certainly in the analogs to history. So I'll stop there, and I'm sure we can dive in more to this theme.
Yeah, keep that chart up just for 1 sec, John.
Sure,
if
let
you
me
can.
get that back up there.
Yeah, throw it right back up there. A couple interesting things about that chart. One is, you can see how we've come off the really excessive valuation highs of the past 2 years, right? As the tsunami of liquidity flooded into everything, with the Fed and Congress and other countries doing the same thing as we did in terms of emergency stimulus. And that peak was the second highest peak in the entire 150 plus year data series you got going on here.
Yep.
So even though we've come off a little bit, we're still a lot closer to that peak, obviously, than we are to the trough coming out of the global financial crisis in 2008 or 9 there. So point being is even though a little steam has come off, we're still largely quite richly valued. And easy way to note that is we're still at the valuation extremes that we were right at the Black Tuesday bust right before the market crash that started the Great Depression happened. Right.
Yeah, and Adam, if you do some further, John Hussman's done some great work in this kind of area. And for example, if you look at, you talked with Ted about the record high corporate margins that will likely come under attack as a result of inflation and margin compression and things like that. If you adjust this type of data series for kind of mean reverting corporate margins, it actually becomes a more robust indicator of future likely returns over, say, the following decade. And the tech bubble peak that you see right here, if you actually adjust, the interesting thing about that valuation is margins were actually kind of below normal. So if you adjust for a normalized margin, we're very similar valuation, not only to the Black Tuesday right before the Great Depression, but also the only other time that these levels have been reached right at the pinnacle of the tech bubble. So a lot of important takeaways here that speak to, we may be in a short-term rally, and we'll talk about some technicals that we're bumping into as a critical proving ground for where we are. There's a tug of war going on between bulls and bears right now in the markets. But these kinds of metrics are nowhere near the kind of lows that you typically see at a durable market bottom. We too, like Ted, think there are new lows ahead of us. Substantially.
Right. In a way to restate what you just said there, John, is that we're still at highs, right? Not even that we're near lows. It's that we haven't even left high territory yet, richly valued territory. Why don't you talk to this chart since you're pulling it up, and then I've got a question for you about the EPS chart that you put up 2 charts ago. So make your comments here, John.
I'm going to hand this off to Mike. Mike's driving that sharing, but it's a very appropriate chart.
John was talking about it, so I just wanted to bring it up. John Hussman does great work. This goes back to 1928. This is the same chart that John just showed of the Shiller price earnings ratio adjusted for profit margins, which profit margins are very extended right here versus where they were back in the tech bubble. Back here, profit margins were 7 or 8 percent, or 7 or 8 cents on the dollar. Here they've been more like 12 cents on the dollar because of huge government deficit spending. Even after the pullback we saw last year, we're above the previous peaks, 1929 and 2000. I just wanted to pop that up there while we were talking about it.
I appreciate you doing that, Mike, because you just made the point John and I were talking about, which is that we are still near highs, and actually by that chart, very close to all the all-time highs for valuations adjusted for margins. So, I think there's kind of a bit of a weariness on a lot of investors coming out of 2022. Like, okay, the markets got beaten up. Hopefully a lot of froth came out. We've had a lot of bad headlines and sentiment. Boy, this is going to be over soon, right? Like the kids in the back of the car, are we there yet? We must be, right? and the sad answer is no, we're still up in nosebleed territory here. John, do me a favor if you can pull up that PE, the earnings projections for the S&P year by year chart. So I just want to note 2 things. One, you rightly said that Ted said he has a really hard time justifying anything over 200 right now for 2023 earnings. So basically that would bring earnings down, if that's where they end up, to basically at or below where they ended the year in 2021, right? So that would be still a fairly, substantial drop from where things are now. And obviously that would need to bring prices down along with it if earnings really do reprice that low.
Yeah.
Question I have for you, while we're talking here, the launch of the video with Tom Lee, aka Wall Street's biggest bull, is sort of running in parallel with us recording this. And when I talked to Tom about this, he basically said two things. He said, yeah, everyone's talking about that 2023 earnings are rich, but to be honest, the downside's already likely priced into them, right? So he doesn't believe they're going lower to 200. But he says, even if they do, let's say earnings, they end up finishing lower than where they are here. Maybe Ted Oakley's right. He said at some point relatively soon, the market's going to start pricing stocks off of 2024 earnings, which in Tom's projections are going to be pretty good. You guys don't necessarily have to share that prediction, but at what point does the torch get passed from the current year's earnings forecasts to the next year's earnings forecast?
Yeah, that's an interesting question, Adam. And the reality is the right way to value stocks are not on a single year's earnings, but the perpetual earnings that owning those shares. If you're going to buy a pizza shop on the main street in your town, are you gonna project 1 year of sales? Or are you gonna say, hey, what am I likely to make in earnings off of that pizza shop for the next 20 years before I try to sell it to somebody else? The whole concept of using a single year's earnings is just absurd in terms of what you're really, what the proposition you're considering is about. I'm glad you brought us back to this chart, because I did want to point out, if you look at the, just eyeball a kind of trend line in the better part of the last decade, you can see it's kind of a trend line that kind of goes through here, kind of a upward slope. But look what happened in the wake of the COVID and the stimulus. I mean, it's basically almost a vertical rise in the forecast and actually the earnings. So much of that was just transfer payments from government deficits into corporate profits. That is not sustainable. We know that. Anybody that has any shred of credibility knows that. So just even a simple eyeballing of this suggests that this blow off, vertical ascent in earnings projections and actual earnings can't be sustained, and there's got to be some kind of snapback there. That just seems, even for the average layperson, to jump out on a chart like this.
That's a great point, John. Two important things to note about that. One, that started before all the COVID extraordinary measures, so we need to keep that in mind, right? That it's not just all COVID. This was a trend that kicked off before that, and that it is like you're saying, it's like a multi-year sugar rush, right? Meaning it's not sustainable. At some point, the sugar rush has to subside. You're going to get the metabolic crash coming down off the sugar high. So this is something that we should have a fair amount of confidence in, that at some point the excessive upward stretched nature of earnings is going to have to start coming down. There's one other thing I want to note too, which is, with the exception of, I think, 2 years, only 2 years in this data series, maybe 3, the year, almost every other year, the year finished with lower earning estimates than were expected at the beginning. So it's just, again, nice evidence here of the comment that's made often, is that Wall Street is just always overly bullish, right? If you're being sold something by somebody on Wall Street, you really got to temper the sales pitch, because the data just shows these guys are always more bullish really than reality merits.
Yeah, that's correct.
All right. If you pull that off, John, we don't have a ton of time left, but I do want to dial through a number of things. One is, you mentioned that we are near a couple of key technical points in the market. Maybe I'll go back to you for this, Mike. Right before we hopped on here, we were talking about how the markets have already had a pretty good start to the year, up about 4% year to date. Tom Lee, by the way, folks, expects us to get to the S&P to rise 20% in 2023. So he's already on his way there with the beginning of this year. I think you said, Mike, that we're bumping up against a really important DMA milestone here. DMA meaning daily moving average.
Yeah, the S&P is at a pretty critical point, and I guess I'd like to just share a chart of that. It's probably the easiest way to show it. We are right at the 200-day moving average. We're above the 50-day moving average. I'm going to pull the chart up here in just a second. And here it is. So here is the daily moving, the daily chart of the S&P 500. We had a swing high on December 13th. I believe that was an important high. It's starting to become a little bit questionable with this rally. This was a big rally of 200 S&P points over the last week and a half. That put it decisively above the 50-day moving average. 50-day moving average is the red one. The 200-day moving average is the green one. And so it's right there, and it's threatening to consolidate and break higher. So, frankly, bears need to be scared, and bulls should be scared, in my opinion. We're right in kind of no man's land. If I go out to the weekly chart, going back to the high last January 4th, you see a series of lower lows, lower highs. 1, 2, 3, 4 so far, and 3 bottoms, and then this downtrend line, which I just redrew this morning. We're right at the downtrend line, so this market is threatening now to break out to the upside. If it does move decisively here, above 4,100 or so, it'll almost certainly go right to 4,200, and then we'll have to live through all of the FOMO type stuff, fear of missing out, and everything else. So we're watching this closely. We're looking at market internals. We're looking at individual sectors. Some sectors are starting to look better, but we're still dealing with this, what I can only call hideous overvaluation. If you think back to that EPS chart, earnings per share chart, a minute ago, really so much of what we're dealing with here in the last 15 years is just faith. You have to have faith in the status quo continuing on forever. And the buy-in on that is pretty extreme. Most of Wall Street says just set it and forget it. It's always going to be okay. The Fed is always going to have your back. Well, the Fed probably won't always have your back. We have to fall back on data eventually. And the data that, for instance, John Hussman puts out there is extremely highly correlated with returns over the next 10 or 12 years. So short term, we have the chance for maybe another FOMO moment, another melt up. But if you believe that we're always and forever going to have growth, the next year is going to be greater than this year, you have to think back to that chart from a minute ago and realize that each of the last 2 times we had an attempt to revert towards a more normal valuation, the Fed had to come in and rescue it each time. The 2008, 2009 timeframe, the COVID timeframe. And if that paradigm shifts at all and we have a reversion towards more normal valuations, we could be looking at quite a significant decline. I personally think that we haven't seen the first phase of this bear market be over yet. We haven't had an acceleration down, an elevator drop moment. We haven't seen investor panic. I think that's likely to happen down here, 3,000 to 3,200, a pretty swift move down, which will cause some short-term panic. And, would then, in my opinion, mark the end of the first phase. But there would still be 2 more phases of a typical bear market before you get to ultimate capitulation. And that number could be quite a bit lower, just going to a monthly chart. This blow off here from the COVID low was pretty historic. We had a widening megaphone pattern and then this giant blow off. All we really did so far is we recaptured the 2021 blow off. So we'll see what happens next, but it's a pretty critical point, and our bias is to the downside.
All right. Well, certainly Ted agrees with you that looking at past bear market cycles that he's experienced, that he's just not seeing any of the indicators that you typically see when a bear market is over here. So like you guys, he just doesn't think this is the time to wave the all clear flag and say everybody get back in the pool. And looking at some recent data in the interview with Ted, we put up a couple of charts from the Institute of Supply Management, manufacturing charts and servicing charts, basically showing that the data there is going in reverse, which basically is a sign of a slowing or contracting economy. Just this week, the past couple of days, we had the Empire State Manufacturer Survey came out. The numbers there for the last month dropped hard. In fact, it was the 5th worst reading in the history of that data. The PMIs, the latest PMI data just came out. It's now negative. It's the lowest reading and first negative reading since, I believe, May of 2020. So this is all data that shows that the economy is really struggling right now, or even contracting. So, to your point, Mike, it's not sort of these are not the fundamentals that you build a sustainable bull run on, right? And maybe there might be, some short-term life in the markets, especially if we break through the 200 DMA that you just mentioned there. But it seems really hard to be making any sort of real fundamental cases here why the market should get excited and try to reprice higher here. I assume you'd agree with that.
Absolutely. Fundamentally, we can't make any case for the market to break higher from here. We haven't been able to do so for so long. I know it sounds kind of glib, but to us, the real argument has been simply the Fed's not going to let it go down, or the Fed's going to create more liquidity. Earnings, real companies are still making real things and producing real earnings, but those earnings are at risk for a lot of different things, not the least of which are increasing interest rates. As companies roll over their debt, and Ted pointed this out, then they're going to have less money to do other things because interest payments are going up, labor costs are going up, commodity costs are going up, and liquidity is starting to come out of the market. So yeah, there's very little fundamental reason. We don't know exactly what the catalyst will be to reprice things more towards normal, but ultimately, to put it simply, that's our theory, is that the moment of justice or comeuppance is near. And the history says that we're going to have a repricing, that you can't intervene forever and expect to be bailed out by perpetual growth. It's a difficult story to keep talking about because it lasts a long time. But we're very concerned.
Yeah, and you do a good job of saying this every week, but it is really like a tipping point, right? So a lot of people use the pushback of, well, hey, it hasn't happened yet, so is it ever going to happen, right? And these tend to be things where the system remains the same until all the last prop keeping it up is removed, and then it changes very quickly, right? So if people are expecting kind of a gradual decline here, you may not be getting that. It may be something a lot more sudden and vicious than that. Also, Mike, to your point, I just want to underscore for folks, you talked about, again, the intervention that has been so critical to where we've gotten to here in terms of these really distorted heights to the upside in terms of valuations. That may really be the thing that's different this year, right? We talked about the M2 chart showing that money supply for the first time in living memory is now beginning to contract. But also the Fed and other major world central banks have switched. I mean, the Fed is now a hiking, tightening organization, which is something that it wasn't. And it spends most of its time in its public appearances basically trying to convince the markets why the markets looks like you keep expecting us to reverse policy, not X, Y, or Z. Now, who's right on that? The markets or the Fed? But let's assume for a moment the Fed does what it says it's going to do. That is very different this time. And if the Fed is not there to rescue the markets, that's a really strong, compelling argument that lower prices, maybe much lower prices, are ahead, because the single biggest factor driving things up over the past decade may be getting removed. All right, John, I want to begin to give you the last word here. With Ted, he made a really important point about loss avoidance. He and I talked for a bit. And as we were talking, I was thinking of you guys, because I know you guys are very like-minded with that. Risk mitigation is a huge part of how you guys manage your portfolio. And Ted just basically said, look, if you're looking to build wealth over time, the first thing you got to do is just make sure you don't get taken out in these market downdrafts. He never wants to have that conversation with a client that says, hey, don't worry, in 20 years, you're going to be fine, right? He wants to be able to say, hey, look, we sidestepped the worst of whatever the market did. And fortunately, you haven't lost. And now you can start building on that once the coast is clear. And he brought up that chart that is, I think his chief investment officer had created, that showed the returns that you get in the year after a market bottom. And Ted had said for Oxbow, those were its best years because largely it kind of played it safe. It got very liquid when times were dicey, sort of like they are now. took sort of the conservative, prudent approach of just, hey, let's just not put ourselves in position to lose much. And if you can do that and the market really does bottom, you get some historically attractive opportunities to deploy capital when everything is fairly priced or maybe unfairly priced to the downside, right? And I know that that's kind of near and dear to your guys' heart at New Harbor. So I wanted to let you talk to that as we take the viewers out here.
Yeah, absolutely. We think that's critical. And during one's distribution years, when one is near or during retirement, the pattern of returns and the timing of down years in the market are critically important to your success. You might argue that when one is saving during their young years and they just need to get from point A to point B, that the path doesn't much matter. And I'll shelve that. We disagree with that too, but it certainly matters when you're in retirement. Any folks out there that have a financial advisor they work with, have them run a financial planning model. Almost doesn't matter which one, and just model the impact of some big down years up front versus some big down years at the end of your life expectancy, and the results are dramatically different. It just speaks to the critical importance of mitigating down moves, especially in the early years of a retirement period. And there's the returns after big downdrafts are very powerful, typically because they're coming from very oversold levels, very low valuations, the kind of negative sentiment that can slowly but surely build into a furious rally higher. And catching those is important, but combine that with missing out on much of the declines of overvalued markets, and you have a recipe there for likely success, right? Nothing is ever guaranteed, and that's one of the cop-outs that our industry, I think, leans on far too much. You got to have a stand, right? We think, and history presents that the probabilities of up and down moves aren't the same at all times in the market cycle. There are times where probabilities of poor returns and downside moves are the much more likely scenario than the probabilities of strong upside moves and muted downside moves. It's critically important we think to have some appreciation for that. And it's not about precision. We're the first to say that market timing, in the way that Wall Street would have you believe people mean what they mean when they talk about market timing, it's very hard to do, but you don't need to be precise, just being in the neighborhood. And in the meantime, there are areas of opportunity. All the charts we just talked about were really focused on the US market, the S&P 500. There are other assets out there that are actually quite attractive, foreign equities, emerging market equities. And not only are they very attractive valuations, but they're showing some very strong relative strength. If there is a bull market out there that's emerging, we think it's likely to be in things like that: emerging market equities, precious metal miners, resources, things like that. And for the balance, we couldn't agree more with the concept of holding dry powder to be able to deploy in those market downdrafts that happen along the way to finding a true market bottom. And you're getting paid 4.5% right now for short-term treasury bills. I totally agree with Ted on that. And there is an alternative here. And the takeaway from this for us, and I think Ted resonated this as well, this is a time to have optimism, not in the conditions that necessarily exist right now, but what likely emerges from these kind of data points that we express concerns about starting to find some footing at more reasonable levels. We look forward optimistically to those scenarios.
Great. That's really well put. Well, look, in wrapping things up, I just recorded, surprisingly, a great interview about taxes. I just interviewed Tom Wheelwright, who's one of the best known, most respected tax accountants out there. And a point he made is, he said, you really don't want to meet with your accountant at the end of the year, when your returns are going to be due in the next couple of months, and say, okay, what can I do to lower my taxes? He said, it's near the end of the year. Your option set's pretty low. He said, you have to really have a beginning of the year kickoff with your accountant to figure out, hey, what are all the things I can do this year to bring my taxes down, my reportable taxes down? And, I took away, God, that's the exact same thing with financial services like you guys offer. Way better to have an end of the year meeting with your advisor than none, but much better to have a beginning of the year meeting with your advisor so that you guys can create a strategy for the year. I see you smiling and nodding as I'm saying this, John. So anyways, John, you just gave a really good example for, why people should have some optimism, even in the midst of some of the big issues that we talked about, and start being to think about how they want to position both for maybe short-term pain in the market, but then to be prepared for long-term gain after that. Obviously it's the beginning of the year. So, folks should go talk to their professional financial advisor and do that planning for the year right now. And if you've got a good advisor who understands all the macro issues and opportunities and risks that Ted and I talked about, or that John and Mike have talked about here, great, stick with them. But if not, consider talking to one of the advisors that Wealthion endorses. It's totally free. There's no commitment to work with them. If you can take that information, you can tell your existing advisor to follow those directions. You can take the steps yourself. Or, if you like the advisor you talk to, maybe it's even John and Mike at the guys in New Harbor there, you can continue conversations with them if you like the advice that they're giving you. It's really just a free public service that they offer. To go set up one of those consultations, just go to wealthion.com, fill out the short form there. The guys will be in touch. All right, well, look, in wrapping up here, I just want to remind folks, we're continuing my practice of capturing my key takeaways from these interviews. I got a lot out of the one from Ted. So if you want to read my notes to that long conversation with Ted for free, just go to wealthion.com/Adams notes. If you have enjoyed these conversation with Ted, want to see Ted and other great minds like him back on the channel, you enjoy these weekly recaps with John and Mike, do me a favor, support this channel by hitting the like button and then clicking on the red subscribe button below. John and Mike, I want to thank you guys for joining me for yet another week. Things are continuing to get interesting in the markets. We're right bumping up against that key DMA limit that Mike was talking about. Maybe by next week, we'll know which way we're going to break. Will we get rejected or will we break through? Whatever happens, we'll be deconstructing it for the audience here and helping folks make sense of it. So John and Mike, thanks so much for joining me for yet another week. Everybody else, thanks so much for watching.
Thanks again, Adam. We look forward to next week.
Thank you, Adam, and appreciate all the folks that watch. And please feel free to reach out as Adam invited.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.